Welcome, mates. In this video, we're diving into the world of investments, a world that can be your best friend or worst enemy, depending on how you navigate it. Imagine you're on a journey. You set out with a modest backpack of resources, hoping to reach a destination of financial security and wealth. The path you choose to take can make all the difference. Investing is like choosing the right path. It's about leveraging your resources to reach your financial goals. Investing is the cornerstone of wealth creation. It's like planting a seed and watching it grow into a mighty tree. You start with a small sum, and over time, thanks to the magic of compound interest, it grows into a substantial nest egg. It's not just about making more money, but about securing a comfortable future for yourself and your loved ones. Investing also allows you to achieve specific financial goals. Whether it's buying a home, funding your children's education, or preparing for retirement, investing can help you get there. But don't be fooled, mates. The road to financial success is not always smooth. Investing can be risky. It's a world filled with complex jargon, unpredictable market forces, and potential pitfalls. One wrong move can lead to significant losses. That's why it's crucial not just to invest, but to invest wisely. Think of yourself as a ship's captain, navigating through stormy seas. You need to have a clear understanding of where you're going, have the right tools at your disposal, and be prepared to weather any storm that comes your way. Now, to help you navigate this world more effectively, we're going to highlight the 10 most common investing mistakes that you'll want to avoid. These are the pitfalls that can turn your investment journey into a nightmare. By being aware of these mistakes and knowing how to avoid them, you'll be better equipped to steer your ship towards the shores of financial success. So, let's get started. There's a wealth of knowledge to be discovered, and it's high time we dug in. Mistake number 1, not having an investment plan. Imagine walking into an unknown forest without a map or compass. Sounds risky, doesn't it? That's exactly what investing without a plan is like. You're venturing into the financial wilderness without any direction. An investment plan is your financial compass. It guides your decisions, helping you to navigate through the market's peaks and troughs. It's your personal strategy, tailored to your financial goals, risk tolerance, and investment horizon. It's the pillar that supports your investment decisions, ensuring they align with your objectives rather than being swayed by market noise or emotional impulses. Moreover, a solid investment plan helps manage risk. It encourages diversification, promotes a long-term perspective, and provides a framework for regular portfolio review and rebalancing. It's like a safety net, catching you when market turbulence tries to throw you off balance. So remember, before you invest, have a plan. Mistake number 2, investing in something you don't understand. It's a bit like wandering into a dark forest without a map, isn't it? You're bound to get lost. Investing in businesses or industries that you don't have a clear understanding of can lead to unforeseen losses and disappointment. It's like betting on a horse race without knowing anything about the horses or the jockeys. Sure, you might get lucky once or twice, but in the long run, it's a losing game. This is why it's so important to do your homework before making an investment. Understand the business model, the market, the competition. Look at the financials. If numbers aren't your thing, bring in an expert or take some time to learn. There's no rush. Remember, a good investment is an informed investment, so always make sure you understand where your money is going. Mistake number 3, chasing past performance. We've all heard the saying, past performance is not an indicator of future results. Yet many investors tend to ignore this advice. They look at the stellar past performance of a stock or a fund and think, if it's done well before, it's sure to do well again. But here's the catch. Markets are unpredictable. They're influenced by a myriad of factors that change constantly, and past success doesn't give us a crystal ball into the future. Think about it like trying to drive forward while only looking in the rearview mirror. You're bound to crash. Instead, consider an investment's potential future performance. Look at the fundamentals of the company or fund, its growth prospects, and the overall market conditions. Remember, investing is about the future, not the past, so never chase past performance. Instead, focus on the potential future performance. Mistake number 4, ignoring fees and expenses. These two are silent but deadly predators that sneakily gnaw on your returns. Let's say you invest in a mutual fund with a seemingly low fee of 2%. Over a 20-year period, that fee, as tiny as it may seem, could consume up to 40% of your potential earnings. Shocking, isn't it? It's not just about the upfront charges, mind you. Some investments are like a complex layer cake with hidden costs buried deep within. Transaction fees, management fees, exit fees, the list goes on. All these costs can add up and significantly reduce the overall return on your investment. This is why it's crucial to do your homework and understand all the costs involved before you make an investment. Compare different options and choose the one with reasonable fees that align with your investment goals. So always pay attention to fees and expenses. They can make a big difference to your returns. Mistake number 5, letting emotions drive your investment decisions. Picture this. The stock market is a roller coaster with its peaks and troughs, its twists and turns. Now, imagine being on that roller coaster, heart pounding, adrenaline surging. That's what it's like when emotions guide your investments. Fear and greed, two powerful emotions, can cloud your judgment. When the market is booming, greed can make you overconfident, leading you to take unnecessary risks. When it's plummeting, fear can make you panic, causing you to sell off your investments at a loss. But here's the thing. Investing is not about reacting to the moment. It's about planning for the future. Making decisions based on rational analysis, not emotional responses, is key. So take a deep breath, step back and look at the big picture. Keep your emotions in check and let logic guide your decisions. So always keep your emotions in check when making investment decisions. Mistake number 6, neglecting diversification. Picture this, you've put all your eggs in one basket and that basket falls. You're left with nothing but a mess. This is what happens when you ignore diversification in your investment portfolio. By spreading your investments across various asset classes, sectors, and regions, you build a safety net for your wealth. Think of diversification as your financial bodyguard. It's there to protect you from major losses that can occur when a particular investment goes south. It's not about guaranteeing profits, but rather about mitigating risk. Consider this. If you were only invested in tech stocks in the early 2000s and the dot-com bubble burst, your portfolio would have taken a massive hit. But if you had diversified and held investments in other sectors or asset classes, your losses could have been cushioned. So remember to diversify your investments to spread risk. Mistake number 7, not rebalancing your portfolio. Now you might be asking, what's rebalancing? Well, it's simply the process of realigning the weightings of your portfolio of assets. It's all about ensuring your investment mix still aligns with your original investment goals and risk tolerance. It's like adjusting the sails of your ship to keep it on course despite the changing winds. You see, over time, some investments may perform better than others, causing your portfolio to drift from its original asset allocation. This could expose you to more risk or hinder your long-term financial objectives. Regularly rebalancing brings your portfolio back to its original asset allocation, aligning it with your risk tolerance and investment goals. Rebalancing doesn't have to be a daunting task. It can be as simple as selling off high-performing assets and buying more of the underperforming ones. However, it's crucial to review your portfolio regularly and make necessary adjustments. So make sure to regularly review and rebalance your portfolio. Mistake number 8, not taking tax implications into account. Taxes play a significant role in your investment returns, often in ways that aren't immediately obvious. Just like a cunning fox, they can sneak up on you, nibbling away at your profits without you noticing until it's too late. Different types of investments have different tax treatments. For instance, some may be subject to capital gains tax, while others might be taxed as income. It's not just about how much you make, but how much you get to keep after taxes. Remember, the taxman always gets his share. But understanding the tax rules can help you maximize your after-tax returns. It's crucial to consult with a tax professional or do thorough research to understand the tax implications of any investment. Ignoring these implications is like leaving money on the table. So, always consider the tax implications before making an investment. Mistake number 9, ignoring inflation. Now, inflation might sound like a dry economic term, but it's a very real factor that can quietly erode your investment returns. Imagine this. You've invested in a bond that gives you a return of 3% per year. Sounds good, right? But what if the inflation rate is 4%? In real terms, you're losing 1% of your investment's buying power each year. Inflation is the rate at which the general level of prices for goods and services is rising. Therefore, it's absolutely crucial to consider inflation when making investment decisions. If your investment doesn't at least keep pace with inflation, you're effectively losing money. Investments like stocks and real estate have traditionally been good hedges against inflation, as they tend to increase in value over time. So when you're planning your investment strategy, don't forget to factor in the silent thief that is inflation. So always keep an eye on inflation. It can eat into your returns. And finally, mistake number 10, not reviewing your investment performance. Now this might seem like a no-brainer, but you'd be surprised at how often this vital step is overlooked in the hustle and bustle of life. Imagine you're on a road trip without a map or GPS. You're driving, taking in the scenery, but have no idea if you're actually getting closer to your destination. That's exactly what it's like to invest without regularly reviewing your performance. Reviewing your investment performance isn't just about patting yourself on the back for the wins or beating yourself up for the losses. It's about understanding how your investments are working together, identifying any weak links, and making necessary adjustments to stay on course. It's like a regular health checkup for your portfolio. And just like your health, catching potential issues early can make a world of difference. Remember, investments are not a set-and-forget affair. So, always review your investment performance. It's key to successful investing. Well, there you have it, mates. The top 10 investing mistakes to avoid. Let's take a moment to recap, shall we? First, we tackled the mistake of not having an investment plan. Remember, a plan serves as your roadmap in your investment journey. It keeps your financial goals in sight and helps you steer clear of hasty, ill-informed decisions. Second, we discussed the error of investing in something you don't understand. Knowledge is power in the world of investments. The more you understand about an investment, the better equipped you are to make sound decisions. Third, we delved into the mistake of chasing past performance. Just because an investment did well in the past doesn't guarantee it will do well in the future. Keep your eyes on the road ahead, not in the rearview mirror. Fourth, we talked about ignoring fees and expenses. These little costs can add up over time and eat into your returns. It's vital to factor them into your investment decisions. Fifth, we highlighted the danger of letting emotions drive your investment decisions. Always keep a cool head and make decisions based on facts, not feelings. Sixth, we covered the pitfall of neglecting diversification. Remember the old saying, don't put all your eggs in one basket? That's diversification in a nutshell. Seventh, we discussed the mistake of not rebalancing your portfolio. Rebalancing helps you maintain your desired level of risk and returns. Eighth, we pointed out the error of not taking tax implications into account. Taxes can significantly impact your net returns, so it's crucial to consider them when making investment decisions. Ninth, we warned about the mistake of ignoring inflation. Inflation can erode your purchasing power over time, so it's important to factor it into your investment strategy. Finally, we cautioned against not reviewing your investment performance. Regular reviews help you stay on track and make necessary adjustments to your investment plan. Remember, investing is a journey, not a sprint. Avoid these mistakes, and you'll be well on your way to financial success. Thanks for watching, mates. Don't forget to like, share, and subscribe for more investment tips. Cheers!